Warren Buffett, one of the wealthiest individuals globally, owes much of his success to investing in companies with a strong and sustainable competitive advantage. Consider iconic brands like Apple, American Express, or Dairy Queen. In this video, we will explore how you can follow Buffett's lead by learning to identify such companies through their financial statements, the income statement, balance sheet, and cash flow statement. This is based on the top 5 takeaways from Warren Buffett and the interpretation of financial statements by Mary Buffett and David Clark. Buffett stresses that understanding these statements is vital for any investor. He even describes them as the language of business and suggests that if you can't understand them, investing in individual stocks might not be for you. But don't worry. Analyzing financial statements can be quite engaging. Buffett humorously notes, "Other guys read romance novels, I read annual reports." It's clear that he has a unique way of keeping his priorities in check. Takeaway number 1. Consistency is king. Warren Buffett often says that the best time to hold an investment is forever. Imagine you had to choose which product would still be popular in 2050. A. McDonald's, which has been serving the same beloved burgers for over 80 years, or B. TikTok, which has been popular for only about 6 years. You have 5 seconds to answer. Write down in the comment section. Okay, the answer is pretty clear: McDonald's. Buffett likes to invest in companies that show consistency. He looks for companies with steady earnings, low debt, and a track record of growth. A company like McDonald's, which has been around for decades and offers a consistent product, benefits from significant cost savings. They don't need to constantly update their equipment, spend more on marketing, or pour money to new product development because people already know and love what they offer. These savings mean more money for shareholders, and by holding on to this stock for a long time, you can enjoy the benefits of compound interest, which has played a big role in making Buffett one of the wealthiest investors in the world. Takeaway number 2. What Warren Buffett is looking for in an income statement. To explain what Warren Buffett looks for in a company, let's use one of his other big investments, American Express. Now let's look at this company's earnings over the past 10 years. They have shown great consistency, which is something Buffett values. Although American Express doesn't have the same long history as McDonald's, its core product, providing credit and financial services, has remained relatively unchanged and its earnings have steadily grown. Buffett also likes companies with a high and consistent gross margin, which shows how profitable a company is before expenses like taxes are deducted. A good rule of thumb is a gross margin of 40% or higher, and American Express consistently meets this benchmark. For comparison, in 2018, Visa had a gross margin of 82% and MasterCard had 83%. A high gross margin typically means that the more a company sells, the more profitable it becomes, which is something Buffett looks for in his investments. Finally, Buffett examines the net margin, which shows how much profit remains after all expenses are paid, to assess how well the company is managed. American Express has a competitive net margin compared to its peers like Visa and MasterCard, indicating that it's a well-run business. A net margin of 20% or higher is a strong indicator of a company with a durable competitive advantage. Takeaway number 3. What Warren Buffett is looking for in a balance sheet. Next up is the balance sheet. Warren Buffett carefully examines a company's retained earnings, which is the profit that a company keeps and reinvests into a business rather than paying it out as dividends. Buffett favors companies with a steady growth in retained earnings because it indicates that the company is profitable and finds good opportunities to reinvest its earnings. For instance, Microsoft's retained earnings have shown solid growth over the years. Unlike some companies, Google doesn't meet Buffett's criteria perfectly for retained earnings growth. This is because Google has been investing heavily in search and development and new projects like self-driving cars and AI. These investments reduce the amount of profit that is retained. However, Google is still highly efficient with its earnings, as demonstrated by its strong return on equity (ROE). ROE measures how well a company uses its profits to generate even more profits. Google's ROE is strong, highlighting that it's a profitable and efficiently run company. Compared to companies like Facebook and Amazon, Google excels at generating profit from its equity. Buffett also considers how effectively a company uses its capital by looking at return on net tangible assets, which offers a deeper insight into how well a company is using its physical assets to generate profits. Finally, great businesses typically don't need a lot of debt to grow. They can use the cash flow from their operations. Buffett likes companies with minimal long-term debt and prefers those that can pay off all their long-term debt with less than 4 years of earnings. Google easily meets this criterion, just as many of its tech peers do. Takeaway number 4. What Warren Buffett is looking for in a cash flow statement. The cash flow statement is another key financial document to grasp. Unlike the income statement, which tracks a company's financial performance, the cash flow statement shows the real money flowing in and out of the business. I might make a detailed video about this soon, so if you are interested, just drop a comment saying I want it. Let's focus on an important figure: capital expenditures. This is the money a company spends on things like factories, equipment, and other physical assets. It's important to check what percentage of company's net earnings is spent on capital expenditures. The lower this percentage, the better. Ideally, capital expenditures should be less than 25% of net earnings, which is excellent, and anything below 50% is still acceptable. However, there can be exceptions, like when a company makes a big one-time investment to expand, always look at what the money is being spent on. Microsoft does a great job here. In most years, its capital expenditures are less than 25% of its net earnings, which is a strong indicator of efficiency. Not all of its competitors can say the same. The cash flow statement also reveals why Microsoft's retained earnings, the profit it keeps and reinvests, haven't grown as much in recent years. Microsoft has been returning a lot of cash to its shareholders through dividends and share buybacks. In some years, Microsoft has even given back more money to shareholders than it earned, which explains why its retained earnings haven't grown significantly. Takeaway number 5. When to sell. Warren Buffett often says it's best to hold on to your investments forever, but there are 3 times when you might think about selling a stock. 1. Better opportunities. If you find an even better investment, especially in a market where many stocks are undervalued, it might be worth switching. Buffett once said in 1974 that he felt like an oversexed guy in a harem, meaning there were so many great opportunities he had to consider trading up. 2. Losing edge. If a company starts to lose its competitive advantage because of changes in a market, it might be time to sell. For example, local newspapers used to dominate, but now online media is taking over. 3. Crazy prices. Even a great company can be a bad investment if its stock price is too high. In a booming market where prices are very high, it might make sense to sell, especially if you can use the money to improve your finances. To sum it up, when searching for a business with a strong competitive edge, focus on consistency. 1. Income statement. Look for steadily growing profits and profit margins that consistently outperform competitors. 2. Balance sheet. A strong business should have high returns on capital, minimal debt, and steadily growing retained earnings. 3. Cash flow statement. Avoid companies that need large capital expenditures. And remember, even top companies might be worth selling in certain situations. Thank you for watching till the end, and if you haven't watched our previous video, then make sure to watch it, and also comment down below which book summary you want to watch next.